Alix. Welcome to Bloomberg Commodities Edge, where we focus on the companies, physical assets, and the trading behind the hottest commodities with the smartest voices in the business. Let's get right to the data dig, where we look at the top stories of the week, and there were a lot of them. You had a big rally in iron ore, you got copper, and you got higher inflation, plus pipeline shutdown. So let's start with the lay of the land and the latest oil inventory data, because it sets the stage for the Colonial pipeline closure aftermath. So this is a combination of distillate and gasoline stockpiles in the lower Atlantic. Now that we did see a big draw over in Pad 1 by about 1.6 million barrels. Now, you did see gasoline rise a little bit, but overall inventories are lower than normal, and that's headed into the summer driving season, and they're already at a 5-year low for this time of year. And distillate inventory saw the really big draw, about 1.7 million barrels. So the other hot topic this week, that was iron ore, at one point hitting $227 a ton. Now, in theory, that would start to crimp some steel mill margins. You buy iron ore and you make steel products. Yet, in part, we haven't seen that because demand is so high. So this chart actually shows the stocks of different steel products over in China. And rebar, which is that blue line right there, which is used in construction, actually saw inventories fall by about 1.2 million tons over the past 2 months. And that means that mill owners are seeing record profits, like $197 a ton in April. Now, caveat, China might be starting to clamp down on these higher commodity prices, so definitely watch this space. And then to the story of the week. Now, these pictures are of gas lines today, right here, and these pictures as of gas lines in the 70s during the OPEC oil embargo. They look pretty similar. So what's been the effect on actual gasoline prices at the pump? AAA prices have just seen the highest level we've seen in about 6 years, going all the way to $3 a gallon. Now, there could be some relief on the way with Colonial Pipeline starting to reshuffle some gasoline about midday today. So let's get into the ring. Stay with this story. So one way to look at it are some of the differentials and the spreads within the market. And this shows what it is. New York gasoline prices are currently higher than U.S. Gulf prices. That reflects a tighter supply on the U.S. East Coast. Now, the pipeline's restarting, so how long does this spread widening actually last? Joining me now, Jeffrey Bear, who covers the gasoline space. He joins us from Houston. All right, Jeff, so we get the pipeline starting up today a little bit. When are we at full capacity?
Matter of days and into a week or more. Some markets are going to get served today, so it'll be fits and starts for a couple of days. We're seeing gasoline come out of Louisiana and Houston right now this morning in the hundreds of thousands of barrels an hour. So things are moving.
The government's also tried to do some stuff to make this a little bit easier, like waiving the Jones Act, etc. What more can they do? What have they done? And is that going to help at all?
The psychological impact of the Jones Act is important. It shows the government's doing something. Those ships need 6 or 7 days to get from Houston to the East Coast, so that's not a rush solution by any means. They have restricted the qualifications on summer gasoline. That means gasoline already in the market is more flexible to market, and it does mean gasoline will get to the drivers a little bit sooner in those states. Georgia's one of those.
As the pipeline starts up, Jeff, do we have an idea of what it takes to restart a pipeline? How hard is it?
Well, the fuel was already in the line when the cyber attack happened, so it's not a matter of getting more fuel into the line. They have to test the system at every length to make sure the flow is fine. There have been no leaks, which there are no indications of any leaks. So it's not an off-on switch kind of situation. It takes a while to get it going. They are promising fuel deliveries to all markets today. So that is a sign of progress.
Jeff, thanks a lot. Really appreciate this. Jeffrey Bear joining us from Bloomberg. Time now for Commodity in Chief, where we talk to one executive in the commodity world. And today it's Amelia DeLuca, Managing Director of Sustainability at Delta Airlines. And the airline industry has some seriously green baggage. By 2050, more than 12 billion passengers are going to fly every year. That's more than 63,000 commercial aircraft will be needed. That means aviation fuel demand is going to top 14.2 million barrels per day, and emissions will exceed 2 gigatons of CO2 a year. That's a 94% increase in just 31 years. So here are some of the options. A plane can use an EV battery like in a Tesla. Hydrogen, but that requires an entirely new plane, or sustainable aviation fuel. That's made from bio-waste or cow methane emissions that can be mixed with regular jet fuel to help green a plane's tank. Now, they can emit as much as 67% fewer emissions than their oil equivalent, but they're not magic. They would only mitigate a fraction of emissions in 2050, less than 1%. Plus, the economics just aren't great. There are only 2 producers out there right now, and prices are 2.5 to 8 times more expensive than regular old jet fuel. Enter Delta. It aims to replace 10% of its jet fuel with its green cousin by the end of the decade, and has agreed to buy 70 million gallons of supply a year, including from 2 startups, over the next 2 years. Now, I recently caught up with Delta's Amelia DeLuca, and I asked her what the company's engine's going to look like in 30 years.
There's not one answer of what this looks like in 2050. So if you think through, there's a couple things that are either here or coming shortly, and then there's longer term technology. So what we have imminently in front of us is sustainable aviation fuel, which right now is made from bioorganics or biofuels, but in the future could be made from synthetic fuels. Bottom line, that works in our current infrastructure, and that could work on planes that we're taking delivery of today, which will be in our system for a period of time. And then what we're seeing in the future, 2 of the things that I think are most interesting is either battery electric, like a Tesla, which you might see in short range flying, or hydrogen as a fuel, which is really what Airbus has proposed at this point. But the thing with hydrogen is that just requires a complete overdo of the entire infrastructure. And so I think when you think about 2050, the way we're thinking about it is that long haul flying will likely be done still with a mix of sustainable aviation fuel. So today's planes, today's infrastructure, hopefully lighter airplanes, winglets, different composition of that airplane itself. And then the shorter haul flying is likely to be done through electrification.
Can you give me a sense as to how much sustainable aviation fuel you guys can use today, and then what you hope it'll be?
What we can do today is we can actually blend up to 50% of our jet fuel composition can be made with sustainable aviation fuel, which exists. There's 2 main suppliers. There's a lot coming on the market. The biggest problem with sustainable aviation fuel today is that the cost of it is 3 to 5 times higher than conventional jet fuel, which is both dampening the demand as well as the supply. And so what you're seeing across the world, but I'll narrow in on the United States, is that, Biden has indicated support for an incentive in this space. A blender's tax credit would help bridge the gap on that price policy.
As you're also doing more research into this field, because it's, sustainable aviation fuel, as you mentioned, and then hydrogen, and then like a battery electric vehicle like a Tesla, what else are you researching? You've got to be putting a lot more money into other options over the next 30 years.
I'll call out 2 other things that I think are really interesting. One is probably fairly well known at this point, which is direct air capture. Direct air capture essentially looks like a mechanical tree, if you can imagine, where it's sucking the carbon out of the atmosphere and it's putting it underground, or in some instances, even using that carbon for new ways to produce new sorts of synthetic fuels, like I talked about a second ago. So now you have a new life cycle of how carbon is used. That's an exciting proposition right now. You're seeing a lot of startups in that space right now. It's not economical in any way, shape, or form, but we know that just like any other, if you look at electric cars or whatever it may be, you've seen those price points come down over time. So we're confident direct air capture will be a big part of our world. And coming back to what I talked about earlier with long haul flying, likely through sustainable aviation fuel, that's where direct air capture can continue to support. And then the other one I would just mention is we're working with a lot of research institutions. We have close partnerships with MIT as well as Georgia Tech to identify what is there beyond jet fuel that is coming from the aviation industry. So some things that have recently been identified are other variants of greenhouse gases, or another one is contrails, those white things you see in the sky. There's not a lot of study behind it, but we're starting to see more and more that also has a fairly large impact on climate change.
If you also had a higher carbon price, would that make sustainable aviation fuel competitive with jet fuel? Like, would that help?
We are open to all of those items. We do watch what is happening in Europe right now, and we recognize and understand the benefit of how that higher carbon price has come into that market and has really spurred change. Focusing on the United States, again, our efforts with the Biden administration are purely on sustainable aviation fuel and that blender's tax credit. We really think that is the one single thing that we need to be able to spur production.
That was my conversation with Amelia DeLuca, Managing Director of Sustainability at Delta Airlines. All right, time now for a commodities kicker. Did you know that there's a chicken shortage? Seriously, what the cluck? And the world's largest producer of poultry is laying the blame on underperforming roosters. So Tyson says that chicken supplies are struggling because the new roosters they've been using for breeding new chicks simply are falling short of egg expectations. Now, the slow rollout is ruffling a lot of feathers as demand for fried chicken sandwiches are going through the chicken coop roof. A Tyson executive says the company is working to replace the rooster by the fall, but there could be a lingering supply hit that carries over into next year. That is no joke. All right, time now for Commodity Radar. What to watch? The Mississippi River. Currently, the river is shut near Memphis because of a crack in a bridge. That's stranded more than 700 barges of ags and metals. And it's a very important artery because it sends grain and soy to terminals along the Gulf of Mexico. And a sustained outage means less exports. And today that meant some lower corn prices. All right, that wraps it up for me here on Bloomberg Commodities Edge. Make sure to catch us every Thursday at 1 p.m. New York, 6 p.m. in London. This is Bloomberg.